Okay, good evening, everyone. If you're live right now with me, let's go. Super excited to be on the call this evening. I'm so excited. If you're excited, come on, just put in your name and let's go live. We are live. Oh, come on, let's go. Yes, that's it. Yes, come on. We are live. We are live. Let's go. We are live now. Let's go, guys. Let's go. Let's go. Let's go. Let's go. So tonight we are today's class is gonna be a little bit brief. We just round off on our session. Okay, we're gonna be rounding off on the session. Um, on the session module. Module 3. We round off on module 3. Ladies and gentlemen, it's going to be an amazing time today. Okay, it's going to be an amazing time today. So, let me know as you're coming into the class. Just put in your name, put in your. Let me know where you're joining from. Okay, so, yeah. So it's really been a privilege to it's really been a privilege to be able to, connect with us on this program. I'm so excited, especially as we move into, the very practical session analysis on the analysis session, if you like. So today we're just going to complete our module 3, where we'll be talking about journaling, you know, trade journals. We'll be talking about let me quickly get to my slide and see. We'll be talking about trade journal. We'll be talking about yeah, I think that's yeah, trading approaches to analyzing the market, and that will launch us into module 4. So in the last class we trading plan. We looked at trading plan, and highlighted to us why trading plan is important. Told us, oh come on, I told us that trading plan is an approach, to executing a trading system. And I told you the importance of trading system. It's important. Everybody needs a trading system. Yeah, okay. Um, Everybody needs a trading system. Everybody. You can't be a successful trader without having a well-defined trading system. And we talked about the importance of this trading system because it just helps you to understand your architectural design. Forex trading architectural design, the same way an architectural design is very integral, very important to construction, is the way your trading system is important to your trading. It's from your trading system, you already can know if you're going to be successful or not. The level of your ability to comply with your own system, with your own rules, it's going to go a long way. It's going to go a long way in determining how successful that you're going to be. Okay, so all you need to understand is that understand some of the key things about trading. You talk about your strategy rules, we talk about your risk control, you talk about your executions, you talk about your routine, you talk about your skill growth. All these are rules, that have to be defined in your trading plan. Everyone needs to understand that if I'm going to be a very successful investor in this industry, you will need to understand. Have a system put in place. Have a system put in place. Do you understand? Okay. So, then previous session we also looked at risk management, where we discussed the concept of risk reward ratio. Risk reward ratio is a key part of determining and calculating risk management. And this is investment, this is financial market. You need, if you fail to understand risk, if you fail to understand your risk, you are going to be missing it totally. You're going to be missing it totally. So there has to be a well defined, you need to know what your risk management strategy is. So your risk reward ratio help you develop a very viable risk management. Do you understand? A risk management when it comes to trading. It helps you to know how much are you risking to make how much. And I've told you, the proportion of your risk to to your reward or to your target should always be at 1:3. So for every one risk you take, you should target 3 profit. For, do you understand? So if you are risking 20 pips, you should be targeting 90 pips as profit. So we had discussed this in comprehensively, so you can refer to previous video to get better insight and to review and know more about that. So today let's go into it. We are discussing trade journaling. And what is journaling in trading? A trade journal is a log that you can use to record your trade. You see, this is one of the biggest mistakes that a lot of traders and investors make in the financial market, either stocks, the cryptocurrency market, the currency market. Generally, if you're going to be a trader, you should have a log, a record of your account, a record of your activity. So a trade journal is that log book, is that log, what do you call it? Excel sheet, where you have a clear picture of all your trading activity. And right there in the image, you can see example of my own trading journal. So if you look at this, I call this this 4 hour trading strategy based on the 4 hour time frame. And right in this journal, you can see the time. It's a weekly journal. It's more like a weekly journal. So the numbers of trade I take in a week, I have it put in there. But then you see, I put in week 1. you know then I have trade entry date. The date at which or in which I enter a trade is listed there. You can see the trading pair, what the pair that I traded. You can see there the order type. You can see the order. Is it a buy instant? Is it a sell instant? Is it a buy limit or is it a sell limit? All those, that's what you put in your order. Now you can see the lot size. Now, what lot size did I use? Is it 0.2, 0.1, 0.1 standard lot? Is it 0.0? Is it a mini lot? Is it a standard? All of that detail, the lot size indicates it. Then you can see my entry price, the price at which I got into the market. And then you can see my exit trade. You see, having an exit trade for me allows me to know whether that trade was an intraday, whether that trade was a swing trade, whether that trade, it just helps me to know. So having an exit day is very important. Because when it comes to trade journaling, you should understand that it can be dynamic and it can be based on your trading system. That's why we talked about trading system earlier. So what's my trading system? A lot that we all determine what record I put down in my trade journal. So I have my exit date on every trade. I have my exit price. I want to know the price at which I exited the trade, the price at which I entered, the price at which I exited. Now, apart from that, I have my stop loss and I have my take profit. You all know what your stop loss is. Stop loss helps you to determine the extent of loss, or a cap, a limit to what possible loss you can have on the trade. So when the market executes your stop loss order, that it stops you, it limits your possible loss. So instead of you losing 100%, you can just lose 1%. Instead of you losing 50%, you can just lose 2%. So you can determine what your stop loss is going to be. And don't forget, we said when it comes to risk, never risk more than 1 to 2% of your account, max 3%. 1 to max 3%, of your account. So your stop loss should take care of that. Now your take profit. If you zoom in on my trade journal right now, and maybe I can get the opportunity. I'm not sure I can do that. Now I'll show it. You can see the take profit. You I have 15 pips stop loss, 60 pips take profit. Okay. So when you analyze this, it's like four. That's splendid. That's splendid. So that means for every 15 pips I risk, I get to make 60 pips. That's amazing. Okay. Now you can see my stop loss, my what do you call it? My pips, my profit and loss in pips, my profit and loss in pips. Now if if it is if it's 15 pips is already determined, then what is the value of my risk? What's the value of my stop loss or my profit in pips? Okay, so here in this scenario, my pips in loss is 15 pips. Okay, and what is my the pip value? The pip value, the loss is equal to $3.40. So and the account is about over 200 $200. So that is just a little bit over 1%, a little bit over 1%. Yeah, a little bit over 1%, which is really good. So it's under 2% risk. I've just reached 2% of my account. At the end of the day, it ended in a loss. What's the risk reward ratio? 1:4. Then you can see the risk reward ratio. That's where you have RRR. That's the risk reward ratio. So I can see my risk reward ratio. Now I can also see the conditions. Now, what are the conditions that I saw that made me going into the trade? That's what you put here under conditions. So I saw a break of support. I saw an inside bar on H4. I saw a supply order, an unfilled supply order at the zonal level. What are the conditions? Now we are in the month of October, we are going to go into the concept of trading concept, into how to set up conditions for your trading and how to pick trading as it were. Okay, so is exactly what you're seeing here. So we have the trading conditions as part of the what you should have in your trade journal. Then you have your remark. Your remark should tell you the result of that trade. Did he hit? Was it a stop? Did he hit the stop loss or did he hit the take profit? Did you break even? Did you partial close? All of those information should be under your remark. Now, for you, you may decide that your trade journal ends at remark. But what I just did a bit is I decided to include information around my account statement so that apart from having my account statement on my trading platform, I can also have my account statement on my journal. So on my account statement here, you can see the balance, you can see my profit, you can see my loss, then my balance for the day. You can see how I have to always bring forward my balance on a new day, so balance brought forward, and you can see all of this information to help me to have a clean idea about my trading. So I have my account statement right there in my own journal. So, but you don't have to include your account statement. That's why I said when it comes to designing your trade journal, you can be as dynamic, as bespoke as you would want to be. Do you understand? So some people have, if you go online and you check trade journal template, you're going to see all manners of templates, but this is what I use. And what does this do for me? By any time I look at a full journal, a detailed journal like this, I can see in the week, in the month, how much did I make? How many trades did I pick? What is the total volume of the risks I took? What the total volume of the my profit target? I can see what's my stop loss, what's my take profit. I can see my average risk reward for the week or for the month, and then I can also see how many wins do I have, how many profit did profit. So it shows that if I see so many, if out of every 10 trades, for example, I win, let's say 6, or I win 8. What does that tell me? I have a very effective trading strategy. That's splendid. Okay. But if my risk reward ratio is tight and effective, even high, if I have high risk, or what do you call it? If I have guess what happens? My risk reward ratio is going to cover for all those losses. So I still end up to be in good profit. Okay. Then at the end of the month or week, what I also get to see is the statement of my account. So I can see how much did I start with for the week, and I can see how much is left in my balance for the week. So I can immediately see the total number of profit, the total number of my losses. Do you understand? So trade journal basically help you to see yourself, as it were, to see your trading activity, to analyze your trade, and it gives you basically, all the necessary information that you need so that it can inform your decision. It can inform your decision because this is one of the tragedies that happen to a lot of investors and traders in the financial market. So you see, they are trading with a strategy, and then they have no trade journal, and maybe they are making profit or they are making losses, regardless of what the results may be, but they don't have a data to analyze and show them what the problem is. So a journal will help you to see where the problem is in your trading, in your system. It will help you to review your trading system, to check your strategy rules, your strategy conditions. Is there something wrong with your strategy? Is there something wrong with your entries? Is there something, do you enter trade too early, or do you get out of trade too late? All of those are the things that your trade journal will expose. It will help you to know. Now, but if you don't have a record, how can you ever know? Just imagine a company who is doing transacting business, who has trade activity going on, have records of, don't have show, don't have expense account, they don't have income and expenditure, they don't have this ledger that you know activity, you know to come and audit the company to know if they are in a, if they are, they are doing well as a business or not. So imagine the mess that would be. Imagine the mess that would be if the company say, we don't have any account, we don't have any record. So that is the sad state of a lot of investors in the financial market. They are trading, they are investing, they are not keeping records of their investment and their trading activities. So at the end of the day, there is nothing to audit themselves with. There's nothing to show them whether they have been making effective trading investment decision or not. Do you get me? So that is the whole idea of trading journal. It's very important. Every one of us must have a trading journal. Okay. So by the time you start trading, we look at this a lot more. Quickly, let's talk about approaches to trading analysis. Now, there are three basic approaches to trading analysis. There is technical, there is fundamental, and there's sentimental. Now, technical trading has to do with focusing on price action. And I told you when we're discussing price action, teaching you about candles and the anatomy, price behaviors, I established for you, how price activity are captured, in the candlesticks. So, and I told you the candlestick body of data, is a body of narrative of event or activity on the floor of the market. Okay, so I told us, so technical analysis is based on assessing data available on the floor of the market, so these analysis are limited to tools like the trading candle, your chart, the candles, the time frames. I think those are the basic things. Candles, chart, time frames. Candle, chart, time frames. Yeah, candle chart time frames. Those are the key tools that are available to you in technical analysis. Okay, those are the key elements of technical analysis. Price action, price behavior. How's price behaving? Is price bullish? Is price bearish? So that's why we talk about trend. Is price in an uptrend? Is price in the downtrend? Okay, so that's another element when it comes to try. That's when we talk about structures of price. What are the market structure of price? Is price at a psychological level? Is price at a supply zone? Is it at a demand zone? This is where we bring in concept of economics as we learned it in school. Concept of macroeconomics. So we have both micro and macroeconomics, you know, in our analysis. So the technical part, we focus a lot on microeconomics, where we are going to be discussing the supply and demand. In fact, you will need to learn supply and demand. It's very important if when it comes to the financial market. So the supply and demand, I hope you still remember all the supply and demand laws and demand laws, supply law, inflation rule, and all of those things. So under technical, that will become relevant. Now, fundamental is a little bit of macroeconomics, because this is where we talk about government policies, influence of government policies on price on price of commodities, price of currencies, and so on and so forth. Because all of these instruments are tied to government policies, government regulations. Currencies are tied to it, commodities are tied to it. Even except for crypto, and even at that, crypto has a leaning in a way, to also fundamental factors. So there are a whole lot of things that comes in from the fundamental environment that actually influence the price movement and price behavior. So fundamental has to do with basing your analysis on country's economic situation, the future prospect, primary data coming from the central banks, the data on interest rate, on inflation, on employment data, policies on consumer price index, policy on purchasing and managers index. So there are a whole lot of data about revolving around government policies. That's why this is the part where we talk about government involvement in the financial market, especially in the biggest of the financial of the market, which is the currency market. So the government policies basically have a lot of sway on the market. Okay, so what's fundamental analysis? Sentimental. What's sentimental analysis? You see, it is a system of measuring how traders and investors actually view and feel about market and the economy at large. So it is a lot more secondary level of analysis, because this is investor, this is marketer who are looking both at technical and fundamental data, and they are using it to assess the situation of the market. They're using it to see, okay, is the market going to be bullish? Is this currency going to be bearish? Is this commodity going to be bullish? Is it going to be bearish? What's the greed factor? What's the fear factor in the market on any particular instrument? And we all know the rule around the greed and fear factor. When you look at the greed and fear meter or scale, you know that basically, as an investor, the best time to invest, the best time to trade is when the fear factor in the market is high, where people are afraid to invest, when people are afraid to put in their money. That is the best time to put in money, and that's the best time to make money. So if you remember, I'm not sure I've shared the story of Warren Buffett with you, but in 1985, when the stocks of Coca-Cola was deepening, it kept on falling. I think right before into the 1980s, the stocks of Coca-Cola was basically falling. What was Warren Buffett doing? A lot of investors were dumping their equities, dumping their shares on the floor of the market. And young Warren Buffett just started picking all those shares up at liquidated prices, at very, very low prices. He started buying them. The further it dipped, the more he bought. The further it dipped, the more he bought. He bought and amassed millions or hundreds of millions of Coca-Cola shares. And fast forward into the 90s, there was a turnaround. The market, the Coca-Cola share started picking up. It started picking up. It started picking up into the early 90s. Before you, in the early 90s, I think Warren Buffett made his $1 billion as an investor. So he was buying where the fear factor was high in the market. People were selling. Oh, I don't want this thing to into a loose trade in my hand, in my portfolio. I don't want my portfolio to dip. I want, let me their losses. Some people just exited, sell off in a loss. But this guy was just buying. People, okay. He made this $4 billion on Coca-Cola shares. So that is the way it works. Okay, so that's what sentimental analysis is all about. So investors and traders look, they look at different things in the market and they say, okay, Euro USD, Euro is likely going to be weak because of Y 2, 3, 4, 5 reasons. Maybe because of anticipated, data from monetary rate policy and so on and so forth. So they just have this bias, this sentiment as to how the price is going to react to the release of certain fundamental data in the market. Okay, so you a lot of time, personally, I don't really look at sentimental. I focus a lot more on technical and fundamental, because basically if you can analyze fundamentally and you can analyze technically, sentimental data analysis just give you a confirmation, a little your analytical result. FEMA confirms it whether you're in line or not. Do you understand? So it's something you can just use to back up whatsoever analysis you have done personally. But the bottom line is technical analysis, fundamental analysis are two major analytical methods that you will need to learn as much as possible. Just pure analysis, whatever they see on the chart, they just study market behaviors and that's it for them. And guess what? It works for them. Okay. So we're going to be as we go into module 4, we are going to be looking at some other major, concepts around the trading the financial market. And then by next week, we are going to move into our technical analysis session. Okay. Technical analysis session where we begin to look at the chart. This is when you will now go and to the chart. I will require you to open trading account, and I'll give you all of those information later in the community. Okay, so what you want to do, once I send in the link, just make sure you register, get ready your a means of identification and a means of proof of address. Maybe the front page of your statement of account, or your utility bill that carries your name, amongst other things. Okay, so that we're going to be looking at that next week when we get into the trade, into technical analysis. We just basically really drive into these analytical methodologies when we get there. Our biggest focus is going to be on technical, but we are going to explore fundamental analysis as well when we get to module 5. Okay, there's still a lot of things. We still have module 4 to go. Wow. Okay, we have not talked about trading styles. Let me see if I can wrap this up in 5 minutes. Trading style. What are trading style? Trading style just discusses your personality when it comes to trading. Your style of trading, how you prefer to trade. And there are 4 major types: scalping, intraday, swing, position. Scalping, intraday, swing, position. Scalping, intraday, swing, position. So it just has to do with your pattern of analysis, your pattern of trading, when you get into the market, how long you stay in the market, in a trade, and so on and so forth. So scalpers are the trader that spend the shortest time in the market. So they are short-term traders. The maximum number of time they spend in the market, they spend minutes. They are in the market for just a few minutes. They enter the trade and then they exit. So because of that, a lot of time what they target in terms of profit is very small. They target 5 pips, 10 pips, 2 pips, 50, 20 pips, and so on and so forth. So in fact, a lot of times some people just target 1 pip, 2 pips, 3 pips. Those guys are scalpers. They are the type of guys that they really sit down in front of the market. For them to be able to get results, they have to sit in front of their system, or be on their phone looking at it back to back. Okay, back to back. Then another thing is that they require fast price movement for them to be able to trade. They need price to move, pin. If price is sluggish and ranging, it becomes an edge for them. In fact, they get frustrated. They need sharp price movement for them to be able to trade profitably. And what else? They trade high volume market session. So this kind of trader, most of the time you see them trade is during London, New York session, where they know that a lot of investors are going to bring in a lot of volume of money into the market in buying and in selling. Okay. Now, intraday trading, let's quickly talk about intraday traders. Intraday traders are guys, they're also short-term traders, but they look at trading just within a day. So they get into the market today and they want to come out today. They get into the market, they want to come out today. The trade may run for hours, okay, but they have to be in the market. They have to be in the market. The trade may run for hours, unlike scalpers who need the trade to run for minutes. Do you understand? So maybe 1 hour, 2 hours, 3 hours, but the most important thing is before the end of the day, they are out of that market. Then intraday traders also are hugely impacted by fundamental factors. Why? Because news are released on a daily basis. Okay, news are released on a daily basis. Now there are certain news that will come in. Let's say, for example, they released FOMC statement. FOMC statement, like last week, is it last week or this week Wednesday? FOMC statement came out, and you can see the movement of price premium. Do you understand? So intraday trader can be heavily influenced, affected by fundamental factors. But for scalpers and intraday traders, they target entry level, and they target entries on lower time frames. They cannot go and pick trades on the higher time frames. Now, about the swing traders are more mid-term traders. They can be in a trade for a couple of days, 1, 2, 3, 4 days, 5 days, and so on and so forth, maybe 7 days in a week and all of that. So bottom line is that they base their trade on trend. Not just on candlestick. So they analyze trade from a longer time frame, from a wider time period, maybe 1 week, what has been happening in the market over the past 2 weeks, over the past 1 week, in fact, sometimes monthly basis. They analyze the market, because they need to get into a trade on a higher time frame. So they base their analysis on trend. They base their entries on trend. They cannot but base it on trend, because if they trade against the trend and they stay in the trade for so long, they are going to lose a great deal. So the last in this category are the position traders. Now, the position traders are the big guys. These are the hedge funds. These are the banks. These are the guys. We are talking about people like Citibank, give me HSBC Bank, JP Morgan, this American Bank of America, Barclay Bank. These are the biggest liquidity movers in the financial market. These guys put in billions of dollars. I'll give you a chart of the highest investors, investor in the market. I think the last time I checked, it was JP Morgan, or these guys have billions, hundreds of billions in the market. They trade billions. These guys can stay in the market for years. You don't get it. They can stay in the market for years. By the time they are coming out in profits from the market, these guys are sweeping the market in billions of dollars of profit. So this guy, I have a guy who is a position trader. This guy has been in gold since 2019. Is it 2019? Yeah, since 2019 he has been in gold. He has been buying gold since 2019. Look at this. He has been buying gold since 2019. Can you imagine? 2019. 2019 is a position trader. Now, since 2019, look at what has been happening to gold since 2019. This is 2016. Look at 2019 here. Look at 2019 here. 2019 is here. I don't know which month he started buying gold though, but since 2019, gold has been buying from around $1,200. So gold has been buying around $1,200 since 2019. Now, where is the price of gold as we talk today? Gold is presently at almost, in fact, it has got to 2,000 this year. It is presently around $1,924 per ounce of gold. Now, let us look at how much this guy. Now, this is a 59.795% growth in the within the period of 2019 and now. And we are talking about, I'm seeing 7,000 pips. This guy has gone 7,000 pips. 7,000 pips on gold. Now, look, and this guy uses nothing less than one standard lot. Now, look at it. When I was teaching you pips calculation, lot size calculation, and we're looking at risk management, I said the pip value of a standard lot is $10. Now, this guy has done 7,000 pips on gold in profit. 7,000 times $10 is how much? I'm talking about this is not even a banker. The guy is just a regular trader. He's just a regular trader. 7,000 times 10. That's $70,000 profit between 2019 and that's on one entry, not on all the entries he has taken. Just one. And this guy has taken like 5 entries on gold. And now. So if we look at it and say the averagely, this guy has done over 15,000 profit, pips in profit. And you multiply that by 10, that's $150,000 over the period of 2019, 2020 makes it 1 year, 2022, 2023, 2020. That's 3 years. So in 3 years, this guy has been in profit of over 150,000, hypothetically. Because I don't have the actual data, but I know that averagely this guy would have done nothing less than 15,000 in profit because of the total number of trades he has taken. If one trade is giving him $7,000, you can imagine that every other trade would have given him at least nothing less than $8,000. 8,000 pips, sorry. 8,000 pips. So 8,000 pips plus 7,000 pips, that's 15,000. Multiplied by 10, $150,000 in how many years? 3 years. Now, if you are making that kind of money, you know that money will no longer be an issue for you. I mean, at least at the level where you are right now, you will shift levels. Okay. So anyway, that's kind of what you see, what's possible when you understand your trading style. You have a trading system. You have technical analysis. You define an analytical style, and of course, you keep your trading journal, and you use effective risk management. So all of these things are some of the things that you get to see. Okay, are some of the things you get to see, ladies and gentlemen. Okay, so that's gonna be the class for tonight. Other events, right? So that's gonna be the class. I'm gonna take questions in the community. So if you have any question, just drop it there for me on the group. I'll respond to it And next week we just go into module 4, and you don't want to miss the module 4 session. It's very, very important you are part of it. It's very important. So you don't want to miss any class from next week, from Monday through to Friday. Make sure you're not missing any class. It's going to be very interesting. Okay. So that's the class for today, guys. Once again, thank you for your patience. Sorry for jumping in on this very late and for the late notification, but then we got to do it. So I'm going to be seeing you in class on Monday. Have a wonderful night rest. God bless you.